All right. It is Monday at 1 p.m., beautiful Bangkok time. It's time for a coffee and a talk about the all-weather strategies. I want to welcome everybody here. My name's Andrew Stotz, and we're going to go through the performance for July and talk about what worked, what didn't work. One of the things that's interesting is that the all-weather alpha focus is starting to perform and get up to all-weather strategy. And it's been a rough start for alpha focus, but in this report and in this discussion, I'll talk to you about alpha focus and why I still think that it's a great strategy. So we'll talk about that. And more importantly, we're going to talk about some behavioral finance things that are pretty critical for how to make sure that you don't lose money in the stock market or you lose as little as possible. So I want to welcome everybody here. I see Krasawat says, good afternoon, Mr. Stotz. It's good to see you. All right. And I want to welcome everybody else here. My name is Andrew Stotz, and I'm going to be talking about our investment strategies that we provide to FINNOMENA. And yep, there's Chayapon. There you go. Nice to see you. Haven't seen you in a while. Good to see you. And welcome to everyone else. Hopefully, I'm going to get your questions answered today and also maybe give you some things to think about. So I'm going to remind you all throughout this presentation to ask questions. So feel free to ask questions because I love to get those and it helps me think about things. It's about 3 minutes after 1 p.m. here, so I'm just finished my afternoon nap, which I usually have. I usually get up about 4 in the morning or so and then start working and do yoga and the like. And so I'm really raring to go. So why don't we do this? I'm going to switch into the presentation and I'm going to walk through some bits of it, and then I'm going to come back and talk to you in more detail. But I want to just welcome everybody. And we have about 154 people now on the line, I see. And I just want to encourage you to ask questions as I go through. All right. Kuna Tips, good to see you. All right. Let me go into the presentation and talk a little bit about it. Again, we're going to be reviewing July's performance. And just ask any questions that you have in the chat. I'd love to get your questions. So we're going to have a performance review of our strategies, and then I'm going to talk to you about gaining behavioral alpha. So remember, our strategies are global, and they're long-term, mainly focused on equity and diversified across asset classes like stocks, bonds, commodities, and gold, regions like Europe, Asia, sectors like tech or infrastructure, and companies. Although right now we don't have any companies in our strategy, we do use these strategies for companies also. So let's remember why we are here. We're here to build wealth. And we're here to build wealth over the long term. I'm not the type of guy that wants to trade in the market and go in and out a lot. You know my strategy, which is pretty solid and steady. I don't like to make changes out of emotions and the like. Now, our target is to deliver steady returns over the long run. This shows our 3 strategies, and in particular, we started the all-weather strategy back in February. We started the Alpha Focus in November of 2021. So February 9, 2019, November 2021, and then about September 2022 for Inflation Guard. These are our 3 strategies. Now, some people, today I am going to be talking a little bit more detail about Alpha Focus, the blue line. Now, it's important to note that we started Alpha Focus at a time that the market was going down. And so performance was kind of bad, and then it stayed flat. And then now we've been rising again, and we can see that happening in both Alpha Focus and in all weather strategies. Now, I'm going to show you a chart in a little bit that's going to rebase everything to the year and the date that we started the all-weather inflation guard. So we'll show that in just a second. So AWS was launched in February of 2019, and we target 6% per annum. All-weather Alpha Focus was launched in October of 2021, and we target 8% per annum. And all-weather inflation guard we launched in July of 2022, and we target 4% per annum. Now, from when we started all-weather inflation guard, again, going back to just when we started, that's July of 2022, the strategies are performing almost as expected. If we rank the strategies by return, we see all-weather Alpha Focus has now caught up with all-weather strategy. And I know I've gotten a lot of questions in the past, when's Alpha Focus going to outperform all-weather strategy? Well, we're seeing some strong performance there. The reason why I mention it is because Alpha Focus has a higher level of volatility, and we're targeting a higher return. So at some point, I believe it will start to outperform all-weather strategy. Now, the next one is all-weather inflation guard, the green line, which has had the lowest return, but also the lowest volatility. In other words, the trade-off for the low risk is low return. But for those people that are looking for a way to invest money, let's say that's deposited at a bank, all-weather inflation guard provides them with a safe place to go, relatively safe. And now if we use the same July 22nd starting date, but we bring the equity market in, that's the dotted brown line there, we mix asset classes rather than hold pure equity to try to avoid a portion of the equity market downturns. So you can see we didn't get hit so hard in that downturn. But it also means that we're going to miss part of the upturns. And that's just the reality. If you want to try to reduce the volatility, you're going to miss both down and up. And you can see it happening right here where we missed some of that peak. So before I get started into that, I'm just going to come back in 1 second. So just want to welcome everybody here. And this is Andrew Stotz, and I'm welcoming everybody. And I see ABB has said hello also. Good to see you. We have 196 people on the call that I can see, that maybe more from other locations. And my question to you is, what are you drinking? I'm drinking a Coffee Works espresso. Hopefully you're not drinking wine or beer or something like that. But hopefully you're having a cup of tea, a cup of coffee. Let me know what you're drinking. Anyways, I want to welcome you all. There's Chachada. Good to see you. And I want to welcome you all. I just started off by going through the overall performance and also reminding you about the long-term nature of what we're doing here. I think one of the things that I always say to people when they ask me about investing is I say, follow your DNA. It's the same thing in corporate strategy, which I teach. And that is the idea that a good corporate strategy has to follow the DNA of the company, of the CEO, of the owners. If it doesn't, it's going to be very hard to implement. And so I really want to challenge you as you're investing yourself in your investment career, that you are investing by your DNA. My DNA is to build frameworks. My DNA is to not be shaken by the emotions of the market. That's my DNA, and that's how I built my strategies. And I think that's what you can benefit from if you follow them. All right, I'm going to go back into the presentation, and let's take a look at the next section. Let's review the performance now. So remember that all-weather strategy is 65% in equity, 25% in gold. So we have three overweights. That's developed Europe and Asia Pacific, ex-Japan and China, and gold. Those are our three overweights in the strategy. Since inception, the strategy was up 42.3%. But boy, look at that crash that we've recently had. And it's 15% above a 60-40 portfolio. So the 60-40 portfolio actually did pretty well recently. In fact, we can see that in July of 2023, the strategy, our all-weather strategy, was up only 0.2%, which was 1.3% below the 60-40 portfolio. So in the month of July, we underperformed. Our target allocation to gold did great, but our allocations to developed Europe and Asia Pacific, ex-Japan, ex-China, were a drag on performance. Luckily, we weren't overweight into commodities, but it wasn't a great month for our performance. Of course, one of the lessons that I've learned in life and of investing is, well, you're gonna have good months and you're gonna have bad months. Our performance in this month wasn't that good, but that doesn't cause me to change anything. Now, do remember, at the end of this month, at the end of October, we're going to be reevaluating the whole strategy and our current weightings. And I believe it's going to be the beginning of September that we're going to come out with our new weightings. So that's coming soon. Let's continue. Let's look at all-weather alpha focus, which gained 1.6%. So a very different story from all-weather strategy. We had overweights in world healthcare, world infrastructure, and gold, but we were only 68% in equity. So let's look at the performance here. And by the way, 68% in equity for alpha focus is relatively low compared to being able to be up to about 95% equity. Since inception, the strategy was up 1.9%. And that's 6.3% above a 60-40 portfolio. And for those of you who are asking, it is after fees. So we try to put up our performance based upon our estimate of fees. And the fees are calculated through the NAV of the funds and the strategy. And so there you can get a picture of that. So now let's bring in the world equity on the screen. And what we can see is that we had a lot less volatility than world equity. And that's our objective, is to gain as much upside as possible without having the downside. So to go into that, let me just highlight this one section right here. We can see, whoops, sorry. I'm just grabbing my pen. We can see here that we didn't suffer any of that collapse in world equity because we have more than just equity in the portfolio. But it also means we didn't capture that amount of world equity outperformance because we do have more than just world equity in the strategy. Now, in July, the strategy was up 1.6%, which was 0.1% above the 60-40 strategy. So just a tiny amount of outperformance, but a lot of outperformance relative to all-weather strategy. Our big tilts to world infrastructure, gold, and global bonds did really well as world healthcare, which also outperformed. So we had a lot of good selections in this period. The main drag on performance was the World Equity Fund, which we always have some portion of world equity, which was down about 1%. Let's talk about all-weather inflation guard, which gained 1%. That's an incredible performance when you think about it for inflation guard, which is very conservative. Well, let's look at it. Here we are only 25% equity and 60% bonds. Mainly that's 45% in global bonds. Here we can see since inception, the strategy was up 7.9%. And that's 6.6% above a 40% equity, 60% bond portfolio. The strategy has also experienced less volatility. So here we can see that the strategy was up 1.1%, which was 0.6% below the 40-60. So we actually underperformed in July, though we had pretty good performance. And global bonds rebounded strongly, but our 10% allocation to gold did great. Our 5% allocations to world energies and commodities, unfortunately, did poorly. So that gives you a picture of the performance. I'm going to switch back to address you and talk a little bit about what's going on, and feel free to ask any questions now that you may have about the performance. And so first question I see coming in, again, ask any questions you want. I welcome all your questions. John Penn says, is the right time to invest more in global bonds? Well, I would say that global bonds, bonds have a benefit when markets are weak. Also, if people think that the Fed is going to start reducing interest rates, then bonds perform well. So I would say that bonds have already made some adjustment because people think the Fed is going to start decreasing interest rates. And so we've already seen a little bit of a run in the bond market. But generally, I would say that bonds are particularly good when you think that the market's going to fall. I have my doubts that the market's going to collapse, and so I'm just cautious on that. But if you look at the all-weather alpha focus strategy, we're only 68% allocated to equity versus being able to be about 95%, which tells you that we're a bit more defensive. So yes, maybe now could be a good time to invest a little bit more in global bonds. I don't know your particular situation, and so I can't advise you, but I think FINNOMENA's got phenomenal advisors that can help you. The other thing to keep in mind is, bonds are basically all about interest rates. And so the more you think that interest rates are going to fall, the more valuable that bond portfolio becomes. Feel free to ask any more questions. I'm enjoying my espresso, and I wonder, what are you drinking? Chachada, what are you drinking? I want to hear. All right, I'm going to go back into the presentation. Before I do that, though, 1 second. Let's say we have a question. You expect recession or not? Yes, I'm expecting a recession. I have been saying that I thought a recession was coming at the end of last year, early this year, but it didn't come. But I do think that we are eventually heading into a recession. And so that's one of my concerns. And it's one of the reasons why we always keep, bonds as a significant part of our strategy. Patnari says, is it a good time to invest in U.S. equity funds while Thai baht is stronger? Well, I don't think that you should be investing in the U.S. equity funds based upon the foreign exchange. So when the Thai baht is stronger, you could buy anything in the world, maybe. In other words, a stronger baht gives you the ability to buy a little bit more of other things in the world. I think you really need to look at the U.S. market and think, is it time to put more money in the U.S. market, separate from the currency? And as you can see from my strategy in all-weather strategy, I'm only 5% in the U.S. market. I mean, that's tiny. I'm kind of scared because that's a very low weighting right now. If the U.S. market was to really fly, then it's going to hurt our performance. But that 5% comes from my quantitative models as well as my qualitative judgment. And the result is that I don't have a lot in the U.S. So we'll see what happens in September. But I would be careful right now with the U.S. I think there's a lot going on, particularly with the election. Juan says, is China still the good option in the allocation? Well, China, I think we have 5% allocation to China. And I think that China can be a technical play. When China has momentum, I think it will get good performance, and I'm willing to hold it for 3 months. But generally, I would not think that China is a great allocation right now. Part of that is because I believe the U.S. is, at war with China in their minds. And so they're trying to keep capital out of China, put pressure on the Chinese economy and the Chinese market. And I think that that's going to hold China back. And that's the reason why I work with Thales Fund Management or Asset Management here in Thailand to launch the Asia ex Japan ex China fund, because I wanted to be able to go to a zero weighting in China. Chachada says, I'm drinking water. Okay, that's good. That's good. Next question. If recession happens, should we invest gold, bonds, or else? Well, if a recession happens, I think you want to be in bonds first, gold second. And you want to be in those before the recession happens. It's too late to be in them once the recession happens. The reason why I say bonds first and gold second is because what bonds basically are going to benefit from falling interest rates. And so basically, if we go in recession, everybody's going to expect the Fed is going to lower interest rates. And that's going to cause your bonds to perform well. In addition, if the equity market starts going down in a recession, bonds typically have a negative correlation with equity. And so therefore, the bonds could perform well when the stock market is going down. Gold, on the other hand, has more of a neutral or zero correlation with the market, which is still good. But it's also good for political turmoil and currency turmoil. And so that's why I say bonds first, gold second, if you think we're going into a recession. Weena says, current war situation, do you plan to invest more in gold? Yeah, I don't like the situation at all, Weena. I think that the let's be honest, there's nobody running the US government right now. Biden's not running it for sure. So who is running the US government? Well, behind the scenes, you have the State Department in particular, and you've got the CIA. And these two organizations are the power brokers of the US. And I think that these two organizations, all they see is how to try to get more power in the world. And I don't think that there's anybody trying to get peace. So I do think we are much closer to war, and we need to get this election done, because really America is being run by someone that's is not capable of running it right now. He's incapacitated, basically. So yes, I think we are in a heightened war situation. And in a heightened war situation, you definitely would increase your allocations to gold. It's important to remember that every single war, every major war, has been associated also with extremely high inflation. And the reason for that is that money is taken away from producing goods and services and towards producing weapons and supporting the troops. And therefore, the result is that you have a reduction in supply of the goods and services that we consume every day. And the number of people in the world is pretty much the same. And so therefore, demand stays high, but supply of goods and services provided to the private sector fall. And that basically means that prices of these private sector goods rise. So we get inflation there. We get inflation also because the government starts printing money to finance the war. And so there is always inflation when it comes to war. So hopefully that answers your questions, Weena. But also, I just want to highlight, I'm not a financial advisor. FINNOMENA has some great financial advisors to help you. And I think it's important to talk to them about your allocations, because one of the things I think you got to be really careful about when you're thinking about your portfolio is not going to extremes. So in other words, someone may think, oh, there's a war coming, therefore I'm going to get into gold. And then they sell everything and they put all their money into gold. That's a bad strategy, because if you're wrong, you're just going to be punished. And that's the reason why we tilt pretty aggressively in my strategies, but we don't tilt so far that we are, extremely overweight any one asset class. All right, let me just look at another. Hold on, there's Book. Good to see you. Yep. All right. And let's go to the next question here. Grassawat says, how's the U.S. elections going to affect all-weather portfolio? Wow, that's a difficult question. Can you ask me an easier question? Makes me want to have a sip of my espresso to answer that. To answer this question, we have to first answer the question, what's going to happen in the U.S. election? So let's talk about the U.S. election just for a moment. One of the shocking things that we can see about the U.S. election is that it's one thing to not like your political opponent, but it's another thing to hate them with a level of hate that is so high that it will last forever. And it won't go away until that person's dead. And even after that person's dead, the hate may survive. Now, I'm not talking about the hate towards Thaksin Shinawatra, which I know in Thailand is very high. I'm talking about the hate against Donald Trump. And even my 90-year-old aunt who lives in New York, listening to the hate that she has for Donald Trump is remarkable. So when I listen to what I thought was pretty reasonable people raise up their level of hate so high, it makes me realize that there are certain people that believe that you should do anything you have to do to destroy your political opponent. And the result of all of this is who has control of the media? It's the Democrats. Who has control of the social media companies, Google search, all of this stuff? It's the Democrats. Who has control of the military machine? Democrats have a huge control now over it. So the Democrats have a lot of control over the mechanisms of government. And it's my belief that they'll do everything they can with these mechanisms to prevent Trump from being president again. And the result of that is that although I think if you had an election today, Trump would probably win, I think that they've got to do something to stop that. And so my ultimate prediction is Trump will not win. And my prediction is that Trump will not win because the Democrat Party will do anything and everything it must do to prevent him from winning. And the result of that now is, okay, let's say if the Democrats win, who is going to be the person that's going to lead the Democrats? Well, right now it's Kamala Harris. I still think that there's other options that could come in. I think Gavin Newsom is an option that I've pushed for a while because I think he's delivered what the Democrat Party wants. But we'll see with the Democrat convention, national convention coming up, what will happen. But I do think that the Democrats will end up getting control of the government in America. And I would say that that is not good for the U.S. economy and stock market. It's not going to be particularly good, particularly when you listen to what Kamala Harris is talking about government intervention. I do think that Americans now are so acclimated to government intervention that they're no longer capitalists where they believe we should have a free market. In fact, I would argue that countries like Thailand and maybe China are even more capitalist nowadays than the U.S. So anyways, all of that explains that I think in the end, the Democrats will win. If Trump wins, I do think it's going to cause the economy and particularly the market to rise substantially. So now let's go to the strategies. Well, we're going to be making our revisions to our strategies in the beginning of September. So that means September, October, November, the election's going to happen in November. So we're going to be positioning for the elections. But I suspect that our positioning is going to be, let's just say if I could perfectly position for the US elections, I do think that there's a possibility that the equity market does well no matter which politician comes in, because there's so much uncertainty with Biden not really there and the conflicts going on between Trump and Harris. So I do think we would get a bit of a bounce that there's been resolution. But then I think if it's Harris, I think it's going to be a weaker stock market. And if it's Trump, I'm going to think it's going to be a stronger stock market. So I'm going to remain diversified, and right now probably keep a moderate level of equity exposure. Because I think that even no matter if Trump comes in and people feel positive about the market, it's not going to push the market to massive heights because we've already pushed very hard in this market. Now, for small cap stocks, it may be interesting. So that gives you a little bit of a background. It's a long story for me to go through that, but that's my perspective. Hansa says green tea. All right, that's a good one. I really need to drink more of that in the afternoon. Another question coming from ABB, who will win the U.S. election? Well, I think that I've given that. As far as the sector outperformance, that's a good question. I haven't thought about it very much. So I don't have an answer to the sector one, but you've got my answer on the market. Just because I'm not allocating that much to sectors, so I'm kind of hesitant to say anything right now. What do you think about emerging market bonds? I think you just have to be a little bit careful. I do like global bonds. With emerging market bonds, you're bringing on more risk, and hopefully you're going to get more return for that. The other thing to remember is that emerging markets have not had interest rates go as low as the U.S., and therefore they didn't bounce back as high as the U.S. And so in some ways, if you look at emerging markets generally, they haven't really had the wild ride that the U.S. has, except if you look at like extreme examples, which are not really emerging markets, more like frontier markets like Egypt as an example, or Turkey. So I would say generally emerging market bonds are okay, but you just got to make sure that you're getting enough upside in them to offset the higher risk. The good news about the emerging market bonds is that you don't have the US dollar exposure because you have the exposure to the currency of the bonds that are being held there. Okay, another one. As you see, many funds, BlackRock, Fidelity, invest in Bitcoin. What do you think we should we have some? Just because in my all-weather strategies, I'm really, really careful. You know, I've got a lot of different people following these strategies, so I really want to be very careful about Bitcoin in there. And that's the reason why I haven't really looked at it. The other thing that you could argue is that bringing Bitcoin into our all-weather strategies at just, let's say, 1 or 2 or 3% is probably not going to have a major impact on our overall performance, both on the upside and reducing the risk on the downside. And as a result, it makes me think, why should I add Bitcoin? Now, let's imagine that Bitcoin is going to go up over the next couple of years. And I could allocate 20% of our all-weather strategy to Bitcoin. Then we would get that upside. But if I'm just going to only allocate, let's say, 1 to 3% to it, I would say it's probably more trouble than it's worth. And therefore, if you're working with your financial advisor or you're working individually and following my strategies, I would say if you want Bitcoin, buy it outside of these all-weather strategies. That would be my advice in this case. Again, I'm not a financial advisor and I'm not advising you personally, but those are my thoughts on it generally. In what case is mutual fund better than investing in index? Well, remember that there is an index mutual fund, and then there's active mutual funds. I think that that's probably what you're asking, RD. I believe that's what you're asking. And, generally investing in index funds is going to give you a lot lower fees. And over time, it's hoped that those lower fees is going to produce outperformance. So generally, investing in passive index funds is a good way to invest. I try to use passive funds if I can, or funds that have underlying assets that are passive. But sometimes it doesn't work, or it's not the most suitable for what we're doing. And so you'll see me using more active and a little bit of passive to try to build a position. But I would say if you were an expert or you wanted to do it on your own, using passive funds is a perfectly fine way of doing it. Chai Sari says, why do you invest more in Europe? Isn't recession affecting? Well, part of the answer to this is that I invest based upon my FVMR methodology, and that's fundamentals, valuation, momentum, and risk. And I look at each investment option, let's say each fund, relative to fundamentals, valuation, momentum, and risk, those four factors. And you may look at Europe and say, oh, the earnings are crap, Andrew, and on a momentum score, it should be very low. Yeah, but on a valuation score, it's also very low. And so it's a combination of these four factors, FEMR, that I use and I score every asset in every asset class, and then I consider it relative to the others. And so what's happening is the reason why I'm overweight in Europe over the last couple of months is because my FVMR scores are more favorable to Europe. Now, sometimes that works and sometimes it doesn't, but I don't want to overrun that strategy or that framework that I have. And that's the reason why I'm holding Europe right now. But I would say that we are reconsidering our portfolio at the end of August. So we're very close. And that means in September, we're going to have possibly, maybe not, but possibly some changings in weightings, which we just don't know yet. Supercorn, great to see you, and good afternoon to you also. I see you've got a question. Seems like market is very volatile from leverage and very volatile before a rate decision. What is your view about allocation after rate decisions confirmed? I think that personally, I still feel the same way I felt for the last year, which is we're probably heading into a recession, and the actions of the Fed, everybody's going to expect that the Fed is going to reduce interest rates. And I expect that they'll end up reducing them to zero. That's my conclusion as of now. It's been delayed longer than I thought, but here we are. So if you think that interest rates are going to zero, well, obviously a bond portfolio would do very well if you're holding a bond portfolio prior to the interest rates going down. But I also think that an equity portfolio could do very well. And so you have to be really careful at this moment in time. Sometimes you can get really negative, let's say the US. And if you take your weighting down really low, like we are right now, you may find that the US bounces back when they announce interest rates going down. And so, yeah, it's an interesting one. Chalum Pat says, Gavin Newsom versus Ron DeSantis election would be best for America, don't you think? Well, yeah, I think you're right, Chalum Pat. I think that unfortunately we're probably not going to get there. And also with the entry of J.D. Vance as opposed to Ron DeSantis, I think that the Republican Party is probably going to get behind J.D. Vance if something happens to Trump, just as the Democrat Party got behind Kamala Harris. But I think that J.D. Vance has a much bigger brain than Kamala Harris, and he stands for something. I think Kamala Harris doesn't have a very strong ideology of what she believes or has not communicated that. The other benefit of Gavin Newsom versus Ron DeSantis is it gives a very different perspective on the way America should go. Gavin Newsom has implemented almost all the things that the Democrat Party loves. And Ron DeSantis has implemented a lot of things that the Republican Party loves. So, yeah, it would be kind of perfect. I think that it may end up Gavin Newsom versus J.D. Vance. The problem with J.D. Vance that he's going to face is that he doesn't have experience like Ron DeSantis has in running a state. And so given that Ron DeSantis is a governor versus J.D. Vance is a senator, I believe, it's a different thing. So I think J.D. Vance is at a disadvantage compared to Ron DeSantis if it came to him having to run for president on the Democrat side, on the Republican side. So on the Republican side, I do think that Ron DeSantis would be the perfect candidate once Trump's off the scene. Next question, ABB, you think inflation will go up when Democrats or Republicans win? I think it's going to go up probably in both, but probably more so when Democrats win, because Democrats are going to talk about government spending and that type of thing. And I think that they're going to do a lot of it. But Republicans spend just as much as Democrats do these days. So I think that eventually you're going to see politicians pushing up inflation through money printing. Nopadon says, what will you think about the Thai market in the next 5 years? Nopadon, I'm so sorry for the Thai market. It looks terrible. And one of the things, we can see the returns in the Thai market just going down and down after years. One of the things, Nopadon, that I don't like about the Thai market is all of the ESG crap that's been put on that market. The market is just under a heavy weight of ESG stuff, and it's just getting worse. And people are just watching it happen. The CFOs and the CEOs of companies know that the burden of the ESG stuff that's being put on them is going to hurt productivity and hurt profitability massively, but nobody can stand up against it. And so we end up with a bureaucracy coming of ESG scores and scorecards, and the SEC and the SET and all the analysts and the government and all the people in society, and all of the weight of ESG is going to cause more and more pain and loss of profitability. So Nopadon, what I would say is that if you're a private business, or if you know private and small, medium-sized businesses, don't get listed in the stock market, because the weight of ESG is going to kill your profits over time. And you don't have the budget to be able to get the scores like the big companies can. And so I focus my attention on small and medium-sized companies that are not under the weight of ESG. I think that's where the good returns in the Thai stock market are, and in the Thai economy are. So that's where I'm focused. Join me there. I think that's where the opportunities are. I'm going to go back to the presentation. I liked your questions, and I'm going to keep answering them. But let me go back and talk about the strategy a little bit more. Before I do, John Penn just mentioned one last thing, is when you reallocate the AWS strategy, we're going to be announcing the changes in the beginning of September. It could be no change. It could be a lot of change. That I don't know yet, but we'll announce it once we get in there. All right, I'm going to go back to the presentation now. And I want to talk about gaining behavioral alpha. Hopefully you can see the presentation now. Yep. All right. 1 second. So this is a seminal report that comes out every year called the Quantitative Analysis of Investor Behaviors report. And it's done by an organization called Dalbar. And since 1994, the annual report has measured the effects of investors' decisions to buy and sell mutual funds. And in the past 30 years, the S&P 500 has returned about 10.2%, according to Dalbar. But then they estimated that the average equity fund investor has only earned about 8% per annum. And that's because of behavioral problems. That's 2.2% lower than the market. And at 10% per year, it takes about 7 years to double your money. But at 8%, it takes 9 years. So what is causing this loss that the average investor is getting? Well, before we get to that, let's look at the bond index. Over the past 30 years, bonds have returned about 4.4%. We're talking about bond funds. But here you can see that the average bond fund investor has not earned anything. They've lost all of this return in the bond fund. The important finding from Dalbar's studies is that the average investor is not earning the market return. Dalbar concludes that behavioral coaching is needed to mitigate risk-destroying behavior. Now, I want to just talk to you briefly about this. This is incredible news. What does it mean for us? It means that if we just leave our money in the market and let it compound over time, we're going to have better returns than if we're trying to get in and out of the market. Now, most people also make big moves, like going massively overweight gold or massively underweight the US. And I definitely think that you should be very careful about those kinds of big moves. But here, what I just want to highlight is that you want to stay invested. And that's a big part of what I talk about in the all-weather strategies is staying invested. So that's incredible research. Let's go back to the presentation and remind ourselves that Benjamin Graham said the investor's chief problem and even his worst enemy is likely to be himself. So, in other words, you are your own worst enemy. Remember that stock that you bought that went down by 30% and you didn't sell? You feel a loss that's 2 to 2.5 times stronger than an equal gain. And this is called loss aversion. This is a behavioral bias. You take on more risk to avoid sure losses. You remember that analyst who never even considered news that was negative about his favorite stock? This is called confirmation bias. It's the tendency to search for and put weight on information that confirms your beliefs. You may ignore information that contradicts your beliefs. Have you ever met someone who wrongly claims, I knew it all along. I told you when the market was going to crash. This is hindsight bias. It's the tendency to wrongly remember that you knew a past event was coming before it occurred. This leads you to believe the world is more predictable than it really is and can lead to overconfidence. 93% of Americans are above average drivers, at least according to themselves. This is overconfidence bias. You're more confident in your abilities and your judgments than is objectively true. Overconfidence can impact your assessment of the quality of the information that you have and your ability to act on it. Though those are just a few of the cognitive biases that we suffer, there's many, many more where those came from. Behavioral finance says we are irrational. On the contrary, from an evolutionary standpoint, our biases are a feature rather than a bug. It's coded in us to quickly react to danger. When we're threatened, we act based on instinct and intuition rather than rational logic. So while those mental shortcuts help us survive, they can also hurt our investment performance. Most of us know that stocks outperform in the long run. You can see that red line right there producing great performance relative to the other asset classes. But stocks are also volatile and can suffer big drops at times. So high volatility and large drawdowns can lead to emotional decisions, which often hurt long-term performance massively. Panic selling is common during big downturns. So these are the best days and the worst days that I tracked over a period of time. And what you can see is that usually the worst days can really cluster and be very negative. You see, I've based this at +6 and -6. And so you see more extreme and clustered, really bad days. So due to this clustering, your loss could grow as you risk also. Imagine losing hope at this moment. You're also missing the biggest days if you get out at that time by panic selling. So it really, really hurts you when you do panic buying and selling. This is how investing feels for many people. It's a roller coaster ride of emotion. And it feels like you're riding high and everything's going well. And next thing you know, you're crashing and you're going down. Investing should feel more like this. And the question is, how can we do that? How can we get to smooth sailing? There's 6 pillars of investing that I see. First, invest in stocks. Stocks have returned significantly more than bonds and gold. And owning a piece of a company means you gain from that what the management team creates. Also, get real about returns. This is a chart that shows the average U.S. stock market average annual return of 11%. And you can see the extremes, ups and downs. So the U.S. market has swung from a negative 37% to a positive 38%. But it's averaged 11%. So it can get very volatile. So to be conservative, Maybe set your expectation of US stock market over the coming decades to about 8% and just try to be in there the whole time. This is the global average, which was about 9%. So the global average has swung from about 39 to about 30 positive, but is average 9. So maybe set your expectation of the global stock markets at between 6 and 8% per year. So the second thing is to reduce risk. Spread your portfolio across various companies, sectors, countries, and asset classes. Avoid overexposure to any single asset. Nobel laureate Harry Markowitz said diversification is the only free lunch in investing. So diversify. During my PhD studies, I published a paper on diversification together with my professor, Dr. Lu Wei, and it was called 10 Stocks Are Enough in Asia. And the research shows that risk reduction comes fast by adding just a few stocks. So here is a portfolio if you own just one stock right there. And here's a portfolio. This is the risk, the average risk if you own 10 stocks. And we can see a massive reduction in risk, almost in half, by owning 10 stocks. That risk reduction by adding an additional 10 doesn't have much effect. So while not an entirely free lunch, diversification can significantly reduce risk while maintaining a high expected return. We aim to keep risks as low as possible for our target return and use diversified mutual funds to get to that risk. Warren Buffett says, rule number 1, never lose money. Rule number 2, never forget rule number 1. So reduce risk. It's an essential part of our strategies. And we're trying to reduce the downside. Number 3, contribute regularly. Implement dollar cost averaging by consistently investing a fixed amount each month. This helps you avoid emotionally driven mistakes when the market's volatile. Number 4, stay invested. Think long-term and have a financial plan. Be patient because the benefits of compounding happen only after decades. Number 5, maintain discipline. Follow your investment strategy. Avoid acting based on emotions by sticking to a well-considered plan. Legendary investor Jim Simons of Renaissance Technology, who recently passed away and was one of the most successful out there, said, only in cases of extreme volatility or if the signal appears to be weakened does the firm sometimes manually cut back. We don't override the models. That's the same way we feel about our structure. Continue learning, deepen your understanding of investing, stay informed about market dynamics, and refine your strategies by learning from successes and failures. Now, we've studied research from Vanguard, Morningstar, and Fidelity, and others to try to understand about returns. A financial advisor can enhance your returns. Ultimately, studies show that financial advisors can improve client returns by 2 to 5%. Vanguard says it's around 3%. The single biggest contributing factor is behavioral coaching, which could add 2%. Providing discipline and guidance could be the largest potential value add. So we're here to help you too. We want to create our strategies for decades. That's me when I'm 100. That's me when I was a baby. And we aim to create these strategies thinking long-term. And our investment framework, FEMR, forces discipline, and we follow our discipline with iron discipline. It's easy to be emotionally affected by market events, which can cause you to make rash and costly decisions. To avoid this, we stick to our framework. The strategies rely on data and structure rather than just feeling. What amount of information you receive about investing is truly important. That's a good question to think about. Dr. Deming, my teacher when I was a young man, that's me on the right, taught me about getting rid of the signal from the noise and understanding what's a signal. And that's really our skill. Between Sonsai on the left and Alex on the right and myself, we focus on trying to think long-term and not be distracted by the noise of the market. So the key takeaways are stocks outperform in the long run, but high volatility and large drawdowns can lead to emotional decisions. And the average investor earns less than market returns. And a financial advisor can help you succeed through behavioral coaching. Our strategies are based on our FEMR investment framework and aim to deliver steady long-term returns. Now, before we get back to Q&A, just want to remind you that bootcamp number 17 is coming up on September 9th. We help finance professionals become valuation experts in months rather than years. And we have many previous attendees coming from FINNOMENA, such as Chachada, who was on this call earlier, and Tosaporn, and Takon, and Jutamas, who also invests through FINNOMENA, and Bunsim also, who invests through FINNOMENA, Pongsakorn also. So in the Valuation Masterclass Bootcamp, you get a 6-week guided, intense online valuation bootcamp, daily live sessions, team support, progress tracking, and you get to write and present a professional valuation report. It is tough. Now we get an extra $100 off at any price point for our FINNOMENA family. Just use the code FINNOMENA at valuationmasterclass.com/bootcamp. All right, let's get into the questions. I'm going to switch over to the presentation. What other questions do we have? I want to welcome everybody. Let's answer questions for a little bit, and then we'll wrap up. First one I want to look at is, if recession happens, should we invest in Thai government bonds in advance? Yes, you probably want to own some Thai government bonds. Of course, the Thai market has been pushed down already a lot, so maybe it doesn't go down as much as, let's say, the U.S. market, as an example. All right, now let's continue on. One second. How does relegation of CIA with major funds like BlackRock hedge fund who are able to lead the market? So what I'm basically saying is that the State Department and the CIA are behind the scenes while Biden is not anywhere to be seen. In fact, I would argue that these organizations have a huge amount of power in America. And the result of that is that they can fire up war pretty much anywhere. And so that's my biggest concern. Tosaporn, great to see you. Just showed a great picture of you, by the way. And we've put in the chat the link so you can get the Valuation Masterclass Bootcamp savings. ABB says, Peter Lynch, investing your stomach is more important than your brain. It's very true. And what I'm trying to do is help you stomach the ups and downs of the market. And so, yes, I agree. Supergorn says, how do you view Japan market as BOJ may not be able to raise rates as they would like to? Seems that equity will rely on Japanese yen compared to US dollar. Yeah, as you can see, I've reduced the weighting in the Japanese market. It was just a short term that we were exposed to the Japanese market. But I would say there is a huge challenge in Japan that I'm not so convinced that they're going to be able to figure out. And so, yeah. Well, it's almost 2 p.m. We've spent an hour. I've talked a lot today. Sorry if I talked too much there. Maybe I shouldn't have talked so much, so feel free to ask any questions. But I think we're out of questions. So I guess it's time to end, and I'm going to see you in 1 month. And in that 1 month time, we're going to be rebalancing the portfolio. So I'm going to be announcing our new weights. Remember, I'm not your advisor. I provide the strategy to FINNOMENA, who can then provide it to their advisors. And so make sure to talk with your advisor or talk to someone at FINNOMENA, talk to your family members as you're thinking about your strategies. Most importantly, think about your strategies from a long-term perspective. And when you do, then you focus on building that wealth over time. All right. That's it for today. I want to thank everybody for joining, and I hope to see you soon. Maybe I'll see you live. We're going to do some live events at FINNOMENA, and it would be great to see you in person. Hopefully, we'll see you there. Meanwhile, have a great rest of your week.